Welcome. In this video, can Zbcn coin go up 11x? We will analyze this. Don't forget to subscribe, like, and please watch to the end to understand.
Like many patterns and structures used in technical analysis, an ascending channel plays a critical role in helping investors predict price movements. An ascending channel essentially represents a price structure that moves between two parallel trend lines. The lower boundary of this channel acts as support, while the upper boundary serves as resistance. As the price fluctuates within this channel, it presents both buying and selling opportunities for investors. In the chart currently being analyzed, a clearly defined ascending channel formation can be observed, with the price bouncing off the midline and beginning a new move toward the upper boundary. Such ascending channels typically indicate that an asset is in a healthy uptrend. This is because the price approaches the upper band with periodic corrections, then pulls back toward the lower band due to profit-taking or short-term resistance, and responds upward again. In other words, both the upper and lower bounds are systematically tested. This cycle shows that there is balance among market participants and that supply and demand are moving in an orderly fashion. The fact that the price has bounced off the midline and is moving upward also confirms the validity and health of the channel. The upper band of the ascending channel is a critical target area, as this is typically where profit-taking occurs and previous highs are tested. If the price reaches the upper band and breaks through with strong volume, it may signal that the uptrend is accelerating and could extend beyond the channel, potentially entering a much stronger bull market. However, if the price is rejected at the upper band, it may pull back to the midline or lower band. Therefore, each band within a channel structure serves as a strategic decision point for investors. The fact that the price has bounced off the midline and is moving upward can be seen as a strong buy signal, especially for short-term traders. This bounce indicates that the price is maintaining its healthy structure within the channel and that the next target is likely the upper band. According to technical analysis, such movements often result in increases of 20% to 50% when compared to similar historical scenarios. Therefore, the current upward reaction from the midline is a highly positive development and provides a signal that can raise investor expectations. For investors, these patterns also serve as guides for risk management strategies. When the price approaches the lower band, stop-loss points can be set, while nearing the upper band allows for planning take-profit strategies. Currently, with the price bouncing from the midline, this suggests that stop-loss levels are positioned lower, and that the current risk is relatively reduced. This is a confidence-boosting factor for investors considering new entries. The price reacting upward from the midline within the ascending channel indicates that the formation remains valid and that the uptrend is based on solid technical grounds. This also suggests that large investors are still active in the market and are supporting the upward movement. Institutional investors typically place high importance on technical levels, and significant volume purchases can occur during these midline bounces, which may lead to sudden upward spikes in price. Moreover, the fact that this structure is forming on long-term charts implies that the price maintains its bullish potential on weekly and monthly timeframes as well. In this case, not only short-term but also medium and long-term investors can take advantage of this pattern. The price, having bounced from the midline, may move toward the upper band, potentially break through it, and continue beyond the channel, initiating a much larger trend. In this scenario, investors should reassess that target prices and update their strategies accordingly. Ascending channels are generally seen as precursors to bull markets, and as long as the channel structure is maintained, they provide a safe path for upward movement. Especially when the price continues to react upward from the midline, market participants gain confidence, and overall market sentiment becomes more positive. This can trigger a chain reaction of new investor entries, increasing volume, and accelerating price momentum. In conclusion, the current ascending channel structure, with the price strongly moving toward the upper band after bouncing from the midline, is a highly positive and supportive development in terms of technical analysis. As long as this structure remains intact, both short-term and long-term upward potential is likely to continue. The upward reaction from the midline indicates that the ascending channel is functioning properly and that the market still has a bullish bias. Therefore, investors should consider the opportunities this technical structure offers, apply proper risk management, and act according to strategic buy-sell plans. The price remaining within this channel presents a promising signal that it may reach much higher levels in the upcoming periods. But we can't make decisions based solely on channels. Let's take a look at other metrics as well. Stay tuned.
I'm interrupting the video for a moment, friends, because Bitunix Exchange has a great campaign. Here's how it works. After registering on the exchange via the link in the description and completing KYC, if you deposit $100 for your first deposit, you will receive a $20 bonus. If you deposit $500, you will receive a $100 bonus. And if you deposit $1,000, you will receive a $200 bonus. I think this is an excellent opportunity for leverage trading. For more details, you can read the articles below. The link is in the description.
RSI is one of the most commonly used technical analysis tools for detecting momentum shifts within the market. The RSI value typically moves between 0 and 100 and indicates whether the market is in overbought or oversold territory. However, beyond this, trend structures that form on the RSI indicator can provide powerful signals about how future price action may unfold. In particular, rising trend lines on the RSI may not always directly align with upward price trends on the chart, but often act as leading indicators. For this reason, trend lines on the RSI are considered highly valuable. When examining the current RSI indicator, we can clearly observe a rising trend structure. This upward trend has formed as the RSI has created higher lows over time, effectively forming an ascending channel. Such formations are highly positive technical developments that signal the market is maintaining strength and that downward movements have been limited. These rising lows in the RSI suggest that, even if prices haven't broken out strongly yet, underlying buying pressure persists and bulls continue to dominate the market. This situation, in turn, boosts investor confidence and supports buy-oriented strategies. The fact that the price tends to bounce each time it nears the rising trend line on the RSI confirms that this trend line serves as an important support level. Trend lines like these on the RSI can be as strong as traditional support-resistance lines on price charts. Since RSI is a momentum indicator, it represents the direction of market momentum. Therefore, this rising trend line also reflects the ongoing upward momentum in the market. If the RSI touches this trend line again and holds, then begins to bounce upward, such a move could signal the beginning of a strong upward price movement on the chart. It is extremely important for investors to closely monitor such structures because a potential contact with the rising RSI trend line and a subsequent bounce would be a highly positive and encouraging development from a technical analysis standpoint. A renewed upward movement in the RSI after such contact indicates that momentum is strengthening again. This could be a precursor to upward movement in the price itself. This scenario is further supported if historical examples show that price also rebounded upward when RSI previously touched this trend line. Past behavior can serve as a powerful clue for future action. The RSI approaching this rising trend line again may be a valuable signal that downward pressure on prices is easing and that new buying opportunities could emerge. In such scenarios, investors may reevaluate their positions based on the RSI's reaction at that level. If the RSI starts to bounce upward from this trend line, investors may choose to enter long positions or strengthen them. This is because trend line touches of this nature in technical analysis often align with major directional shifts in the market. Another important point is that as long as the RSI doesn't break below this trend line, the bullish structure remains technically intact. In other words, as long as RSI holds above this line, the market is still seen as being under bullish control, with corrections considered temporary and followed by renewed upward movement. Therefore, the RSI's adherence to this rising trend line is very significant for the overall market outlook. If this line is tested and successfully defended, it shows that the bulls are still strong and continue to intervene in the market with confidence. In technical analysis, structures like these observed on indicators such as RSI play a decisive role, particularly in medium and long-term investment decisions. This is because momentum shifts that are not clearly visible on the price chart may appear earlier on leading indicators like RSI. This gives the investor an edge in timing and making accurate moves. For this reason, preserving the rising trend structure on the RSI and closely observing the outcome of any potential contact with that line is essential. Additionally, these types of formations on the RSI provide not only directional clues, but also important insights for risk management. For instance, entering a buy position as the RSI approaches and begins to bounce from the rising trend line allows the investor to define a much clearer stop-loss level. If the trend line is broken to the downside, a stop-out limits losses, while a rebound in RSI to the upside can present strong profit potential. In other words, this setup offers both a positive price forecast and a method to limit losses. In conclusion, the rising trend structure observed on the RSI indicator is extremely valuable from a technical analysis perspective. This structure can indicate not only the current state of prices, but also the potential for future movement. Especially if the RSI approaches this rising trend line and bounces upward, it signals that prices may once again gain upward momentum. This should be viewed as a very promising technical setup for investors. Movements of the RSI along this rising trend line reveal much about market sentiment and, when interpreted correctly, can offer great opportunities. Therefore, investors should never overlook RSI trend structures and should monitor these types of technical patterns closely. RSI must not break this trend.
The inverse head and shoulders pattern currently forming in the price action is typically seen as a strong reversal formation that appears after bottoming phases in the market, offering significant bullish signals to investors. This formation consists of three main parts: the left shoulder, the head, and the right shoulder. In the left shoulder, the price pulls back from a certain level. During the head, a lower low is formed, and in the right shoulder, the price rises again near the level of the first shoulder. The core meaning of this structure is that the market is gradually losing its downward momentum and buyers are regaining strength. In technical analysis, the appearance of such a pattern indicates a shift in the supply-demand balance, suggesting that selling pressure is weakening while buying pressure is increasing. Looking at current price movements, the right shoulder of the inverse head and shoulders pattern appears to be forming. Once this right shoulder is completed, the pattern will be considered complete and a strong move toward the neckline can be expected. The neckline is a critical resistance area in this formation. If the price breaks through this level with strong volume, the breakout typically confirms the pattern technically. In this case, the upward price movement is likely to continue, and the projected target of the formation may be realized. To determine the target of this formation, the distance between the low of the head and the neckline is measured, and then projected upward from the neckline upon a breakout. In the current scenario, the difference between the head and the neckline is quite substantial, indicating a strong upside potential. Based on calculations, this distance suggests a price increase potential of approximately 11 times. In other words, if the pattern completes successfully and the neckline is broken to the upside, the price could potentially increase 11-fold. This represents a significant profit opportunity for investors and is why many closely monitor such formations. The reliability of inverse head and shoulders patterns largely depends on the price level at which they form, trading volume, and the overall market trend. If this pattern appears at the end of a downtrend and is accompanied by a noticeable increase in volume during the neckline breakout, the validity of the pattern is further reinforced. An increase in volume confirms that the pattern is a bullish reversal. Observing current price movements, the recovery in volume and the development of the right shoulder suggest that this technical structure is progressing in a healthy manner. Volume is expected to increase particularly as the neckline is approached, which would indicate a strong breakout. Such technical setups offer strategic positioning opportunities for investors. The moment the pattern completes and the neckline is broken is often considered a buy signal by technical traders. Investors who enter at these levels may achieve significant returns once the target price is reached. However, as with all technical formations, it is important to evaluate this pattern only after confirmation. Assuming the pattern is complete without a neckline breakout carries risk. Therefore, waiting for confirmation is a safer strategy. Additionally, setting stop-loss levels is critical for proper risk management. If this pattern completes successfully, with the potential for an 11-fold increase in price, it becomes highly attractive to investors. This upside potential is not only due to the technical structure of the pattern, but also supported by market psychology and increasing investor confidence. In technical analysis, chart patterns are more than just shapes. They reflect the behavior of market participants. The inverse head and shoulders pattern visually represents a shift from indecision to renewed buying conviction among investors. Another key factor investors should pay attention to during the formation of such a pattern is timing. Each phase of the pattern unfolds over time and must be monitored patiently. The progression from the left shoulder to the head, from the head to the right shoulder, and finally the approach to the neckline can all take time. While small fluctuations and corrections may occur during this process, maintaining the overall structure is vital for the pattern's validity. At this stage, the fact that the price is not dropping sharply and is holding near support levels during the formation of the right shoulder helps preserve the integrity of the pattern. Otherwise, the pattern may become invalid and the bullish expectation may weaken. For the pattern to continue developing healthily, it is important that the right shoulder does not exhibit excessive weakness. If the right shoulder completes too quickly and with low volume compared to the head, this could indicate waning buying interest. However, current price action shows that the right shoulder is forming clearly and buyers are still active. This strengthens the likelihood that the pattern will continue to develop. Additionally, it is important that the price remains strong at key support levels and does not drop below the previous shoulder regions. Such a move could invalidate the pattern and compromise the technical setup. The fact that the formation's target implies an 11-fold price increase presents a major advantage for medium and long-term investors. Achieving such a target may take time, but the visibility of this potential on the chart is enough to motivate many investors to hold until those levels. These kinds of large targets are usually achieved not through sudden moves, but through steady and step-by-step progress. Therefore, investors should follow the pattern's development with patience and view each correction as part of the overall structure. This approach helps avoid emotional decisions and supports a sustainable investment strategy. In conclusion, the inverse head and shoulders pattern currently forming in the price action is generating highly positive technical signals. If this pattern completes and the neckline is broken to the upside, the price has the potential to experience a substantial rally. From a technical analysis perspective, the target of this pattern points to an approximate 11-fold increase. This potential represents a significant opportunity for investors to monitor closely.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.